The following segment is sponsored by Xterra Incorporated, trading on the TSX Venture Exchange under the symbol XAG.V. Xterra plans to become a mid-tier producer of silver and base metals through the development of its Bilbao deposit located in the central Mexican mineral belt in the state of Zacatecas, as well as through additional exploration and acquisition opportunities. Find Xterra on the web at xterra.ca. Join me for a conversation with a frequent guest of the show, David Morgan, the Silver Guru, an expert on money, metals, and mining, also a lecturer and an author. Mr. Morgan has written Get the Skinny on Silver Investing, available on Amazon.com. His website is themorganreport.com. David, welcome back to the program.
Oh, it's great to be back.
Now, you forwarded me a comment from one of your subscribers for discussion on today's broadcast, and the comment is certainly something we've touched on before in earlier conversations. Let me just read the comment from subscriber Colin. Hi, David. Enjoying your Basic Plus membership. I've been reading Martin Armstrong's website. Martin has some strong views that make sense. Gold won't go up until 2015, 2016. The dollar will get a lot stronger in coming years. The S&P likely to double in the next 3 years, and he's certainly not a hyperinflation believer. Could you maybe do a podcast about where you and Martin agree and disagree on these issues? Thanks. David, what are your thoughts?
First of all, I have read Martin Armstrong's website. I certainly wouldn't say I've read it in its entirety. I have not. Also, I would mention that at the Liberty Forum that I did in Dallas, Martin was one of the guests. Unfortunately, I guess he had some issues and couldn't make it physically, but he did come on a podcast. One, let me state, I think he's very well respected, as he should be, and a very good, deep thinker, and he's got a lot of insights into monetary issues. So I'm going to tackle them one at a time. Gold going up. Now, I don't know his exact work, but in the context of what I think and what our work shows, I agree. What I mean by that, and more specifically, is let's just revisit the last bull market. If you've looked at some of my work, and I think he's a Basic Plus member, so he's probably seen some of the videos, and I've been repeating what Jeff Christian said early on in the bull market, that 90% of the move comes in the last 10% of the time. And I kind of parroted that. I knew we had a huge move in the last part of the time, but I didn't really know what the numbers were, and I actually did a whole presentation on that, and determined that I think it was 87% of the move came in the last 7% of the time. Not to pick hairs, I just didn't do the arithmetic. I have done it since, and I think that's the exact numbers. But the idea that 90% of the move comes the last 10% of the time. So this could be totally acceptable to my thinking that we could move higher in through 2014 and higher into 2015, but in 2000, say at the end of 2015, I think someone told me it was 2015.75, which would mean the fourth quarter 2015, and I don't know how far he projects it out into 2016, where you'll get the final peak. But this would be very similar to the way one markets move. I mean, if you look at the tech bubble, how it moves, you look at the housing bubble, you look at all those type of markets, any market really, once it gets very, very extremely overbought, it accelerates rapidly. So doesn't mean that the metals will be flat until that time. And I don't know what he thinks, but what I think, and you're asking me what I think is that you'll see them work their ways higher. I think we're going to, get to 226 on silver this year after being as high as 48. In 2014, work even higher, work higher into 2015, and then at this, whatever that trigger point is, and no one really knows, I think Martin says he does, and perhaps he does. I won't argue that. Time will tell. Whatever that point is, and you get this huge acceleration. So going back to the 1980s bull market, silver started in 1979 around $6 and ended January 19th at 50. So you made eightfold on your money in the last year of time, if that was about a 15-year bull market. So if this is a similar 15, 16-year bull market, will you get that last eightfold increase in the last year's time? I don't know. But what I am suggesting is that's how the market moved last time. I think we see something similar this time. So I would say we somewhat agree. My time frame for the peak is around that time frame, so let's leave it at that.
The next point in the comment was the dollar will get a lot stronger in the coming years. The S&P likely to double in the next 3 years. Certainly not a hyperinflation believer.
First of all, I don't rule anything out. There's a lot of gold believers, gold bugs, you might say, that are, make a strong case that gold is inversely correlated to the dollar. And they even put up charts. I can name a few. Ian McAvity, for one, he can take a chart of the dollar and then flip it around on one of those overhead projector screens, which you have to be about my age to even know what those are, and then overlay it on a gold chart, and they almost overlay. So you can make a strong case that the dollar and gold are inversely correlated. But really, from my work and what I studied and from people that have been before me, it's really a reflection on overall economic health. If we had a inflationary boom, not a hyperinflationary boom, and things looked better or appeared better, or even if not, you could just pump up the economy with these dollars coming in, and you could certainly do what he has suggested here. Now, do I agree with that or not? I think it's more likely that you would see what the main trend is, and gold is the most negatively correlated asset to the stock market. But that doesn't mean day to day, minute to minute, week to week. And let me just back up a little bit and mention a name here, and that's David Ben Simon. And David wrote a book, I forget the name of it, but it's a financial publication. It was like a $750 book. And he uses a very similar strategy to what I think Martin Armstrong does. And I don't want to misstate anything because Martin isn't here to speak for himself, so it's my interpretation, and I may be misstating this. But he uses this pi factor, this golden ratio, I think it is, and what it does is it shows the movement of gold and silver and what their ultimate tops are. And in that, he says that the overall markets will pretty much all be going up. And Robert Prechter's made that argument as well, all these markets moving together. So it has happened. Could it happen again? Yes. Do I think it will happen? I would be more inclined to see the dollar neutral to down as the stock market goes up and goes up even more, and then a breakaway at some point. So I don't know what the time frame is here, so let me just pause a second, gather my thoughts, and just say that, yeah, you could see what he's saying, the dollar going higher, the stock market going higher as gold rebuilds its base and comes back up, and silver rebuilds its base and comes back up. And as far as hyperinflation, I agree. I do not see hyperinflation. I see inflation, which we have, although it's certainly not noted by the government statistics, but I would argue that the inflation rate is far higher than what is stated in official figures. And secondly, I think that you'll start seeing some of the money pour into the mainstream economy. Right now, all of the money that's been, you could say, printed, electronic digit money that's been pushed out in the system is sitting in the bank's balance sheets. It really hasn't gone out into new loans. And even wealthy corporations are sitting on a great deal of cash. So if or when that cash starts to move in the economy, it's got to go somewhere. Well, gold is a very small market, silver even smaller, but the stock market is a pretty vast market, and the currency markets are huge. So that money, if it's released, in other words, the banks start to loan it out into the market, certainly you can make that argument. So do I agree? Somewhat. The one that I'm most certain about is the gold-silver situation. I think there we're pretty much in agreement, although I don't know exactly what his curve looks like, and I don't know. No one knows the market. I mean, it's going to do what it's going to do, but I see it basing and moving higher, and it'd be a good time to be in gold from this point all the way to the end, but you're not going to get the huge gains. I'll restate something I've said on other programs, and that is the easy money's been made. The money that's been made from the early 2000s up until, say, the 2011 peak in silver, that was fairly easy. We were in a bull market, and of course it's very volatile, I admit that, but that was the big leg. That was fairly easy just to buy and hold all the way through, and if you're lucky enough to get out the top, then great. The big money is ahead of us. Now, what I mean by big money is rapidly increasing appreciation, especially in the mining stocks. But it's going to be tricky, because what happens is it becomes a feeding frenzy. It becomes a manic, panic buying frenzy. And anyone that's thinking outside of the box, if it can only go higher and there's no tomorrow and gold's going to pick a number 1000000, I mean, things just get absurd, and that's what happens at market tops. It's really hard to stay cool, calm, and collected. Say, no, this is overvalued, we're going to take some money off the table. So that's what I'm looking for, again, in the same time frame as him.
So you're basically in agreement with Martin Armstrong, but not necessarily aligning yourself with noted hyperinflationist John Williams.
The only argument I have with John, I believe, is statistics. And it depends how you define hyperinflation, but advanced capital markets have bonds, and that's what we have. And right now, interest rates are going up, and the Fed doesn't really have much control, as most people think. The Fed is worried that the interest rates are going up. In fact, Ben Simon talks about that in his book. And as those interest rates go up, bond prices go down. So that's deflationary. So that takes money out of the system more or less. In other words, if you have to cash your bonds out, you're going to get less money paid for them at $1,000 face value. If interest rates keep going up and up and up, you might get $900 for it, or $800 for it, or $700 for it, or whatever. So that is a counterbalance to the hyperinflationary argument. And that's really what happened in 1980. People say, well, gold couldn't go up as interest rates rise. Well, that's not true. Gold went up during the interest rates rising until Volcker moved them up at such a rapid rate, and real interest rates became positive. So let's define that quickly. If the true inflation rate is like 9% or so, I think what John Williams says, then you have to get real interest rates to 11 or 12 before the real rate is a positive 2%. So how do you get the positive 2%? If you have a 10% inflation rate and a 12% yield, now the real rate back to you is 2%. Because you have to subtract out the true inflation rate. So these are concepts that I think a lot of our listeners are aware of, some aren't. It takes a little bit of work and study, and if you don't understand it, you probably would like to read Martin Armstrong's work, maybe read some of mine, but that's the basics of it. So you could see gold continue to go up as interest rates go to 3%, 4%, 5%. So, geez, gold's going up, well, interest rates are going up, and the reason is yes, because the real rate is not positive yet. It looks positive if you don't know what's really going on in the economy and how to really measure things, but if you understand it, and that's what Volcker did to stop the gold market. He basically slammed the brakes on when he put interest rates up over 17%.
When interest rates go up like that, or coming close to going up like that, it's often not a bad sign for the economy, is it?
Well, it depends. First of all, the market should determine interest rates. And then you're going to have an economy that's more free market. The market's allowed, without any interference, to determine what interest rates are. Then the market will balance what the true cost of money is. But when you have banking consortium that can dictate what the cost of money is, it distorts things greatly, and that's what we've had. You have huge misallocations of capital. So since we've had that for so long, you've got these huge misallocations, and some of this money doesn't know where to go, so it goes wherever it can. It goes in the housing market, it goes in, it creates a bubble, and then that bursts, it goes in the tech thing, it goes going into bonds. I mean, bonds are the biggest bubble that's out there, and then that one's starting, there's a pinprick in the bond market right now because interest rates are going up. So is it a good thing? Interest rates, I'm neutral on it if the market determines them. If you put them up too high, then it chokes off all economic activity other than people that have money that they can push in and save it. In other words, the best move you could have made in the last bull market in gold was to sell it at the top or near the top. So say you got out at 700 and buy the 30-year bond and, yielding like 17%. And then as interest rates came down, those bond prices went up. So, I mean, that was the sweetest deal on the planet. For 30 years, you were getting a 17% yield, and the value of your bonds just kept increasing. That trade has ended. It's been a 30-year wonder bar. I mean, that's been the best thing you could have done. But that day's it's ended as far as I'm concerned. So now, what do? Well, you study, you educate yourself, you diversify, and you stay nimble, be flexible.
We'll be right back. The Ellis Martin Report is sponsored by Xterra Incorporated, trading on the TSX Venture Exchange under the symbol XAG.V. Xterra is a Toronto-based resource company, and their primary project is the Bilbao silver-zinc-lead-copper deposit situated in the Panfillo-Natera district of Zacatecas, Mexico, approximately 50 kilometers south of the state capital of Zacatecas, where Xterra is currently completing a bankable feasibility study. Between the company's Bilbao, Laguna, and Panfillo projects, Xterra has a resource of 100 million silver equivalent ounces, including 33 million ounces silver in 43101 compliant resource. Zacatecas is a well-known mining district with infrastructure in place. Mining opportunities are both open pit and underground. There are no significant environmental issues, and there is an available local workforce there, as well as goods and services for development of the projects. You can find a full investor prospectus on Xterra's website. Just log on to xterra.ca or find their logo and click through on the homepage of our website, ellismartinreport.com. And we're back. We touched on mining stocks a few minutes ago. We're pulling into September very quickly. Everyone will be returning from vacations. The summer is ending. What are some possible good moves for subscribers and listeners to make before Labor Day rolls in?
Well, the HUI, the XAU are starting to outperform the metals, and this is something you look for to confirm the bottom. So I think the bottom's in. I've called it and said on your show before. And really well-chosen mining equities, I think, are really going to be the place to be. It doesn't negate what I've always said, and that is you should have real metal first before you buy any mining shares. But assuming you do or you're going to do that, then I think the mining shares carefully selected are really the way to go. And again, at the end of the market where you get this manic panic frenzy buying I talked about a moment ago, at that point in time it doesn't matter what stock you buy. Not that that means you should buy any stock willy-nilly, but at that time when the public wakes up to the gold and silver story and panics into the market, any stock with gold or silver in its name will fly for a very brief time. That's what I said. The big money is ahead, but you got to be careful. I watched it in the last market. I think it'll happen in this market and make history books because there'll be so much of it going on for a very brief period. So, quick example, at the end of the last bull market, a friend of mine bought a stock that was Golden Knight, I think was the name of it. It was on the Amex exchange. It was a $2 stock. It was $4 about a week later during the manic panic buying phase. He sold it for a quick double in a week. Then he did his research. It was not a gold company at all. It was a women's lingerie company. So this is what happens in these manic panic buying frenzies, is anything with gold or silver in its name. So any stock that's around. But the caveat is you don't want to buy any cheap stock now necessarily unless it's really well researched, because a lot of these stocks still, with the next couple of years as we work through this overhead resistance that we have in both gold and silver, it'll take some time in my view. Some of these companies probably don't have the capital to sustain the next 2 years. A lot of them do. You just want to choose wisely.
And lastly, David, educate our new listeners about the Morgan Report.
Well, because we focus on money, metals, and mining, and we devote it to you, which means you are the focus of every report. Every time that we sit down and write a report, we have you as our best interest. We invest right along with you. When the time comes to make a decision, we're right there with you, and we're not perfect, but we certainly have your interests as well as ours in hand when we write the reports. And subscribers do, at the second level, the basic plus level, where this guy wrote in, you have the opportunity to ask questions like this, and we guarantee an answer. Not maybe the answer you want, but we'll give you an answer.
David, once again, a great segment. Thanks so much for joining me today on the program.
My pleasure. Thank you.
I've been chatting with David Morgan. His website is themorganreport.com. Listen to the segment again on the podcast page of our website, ellismartinreport.com. The preceding segment has been sponsored by Xterra Incorporated, trading on the TSX Venture Exchange under the symbol XAG.V. Xterra plans to become a mid-tier producer of silver and base metals through the development of its Bilbao deposit located in the central Mexican mineral belt in the state of Zacatecas, as well as through additional exploration and acquisition opportunities. Find Xterra on the web at xterra.ca.